Do you think that Tesla stock is crashing now? Well, it seems that some do. The stock market has become undeniably unstable in recent months. Others believe that Tesla stock is crashing and will continue to do so. You definitely would not want to miss this info. Tesla shares have plunged more than 20% in less than 20 days. There are several reasons for that, but a new catalyst now has the drop gaining momentum. On the morning of October 5th, a couple of days ago, the stock was trading at its morning lows, down 5.4%. That said, others expressed that Tesla's fundamentals have changed. This is based on the fact that Tesla is down over 8.6%, while the NASDAQ 100 is up by 2.27%. This led people to believe, especially retail traders who were big supporters of Tesla stock. They underlie a lot of the volume for Tesla stock by helping prop up Tesla prices and until recently helping Tesla actually outperform the NASDAQ 100 index year to date. However, that has come to an end according to some. Others are not quite ready to admit yet that Tesla's stock continuous success has ended, but has just undergone a slight change, a change that many hope will bring good news for the company and its stock. According to a Tesla enthusiast, there are three major reasons why there are seemingly negative changes in Tesla's stock, or at least why the stock is now crashing. Before we go on, Moomoo developed a new function, the industrial chain. Suppose you want to find out the stocks that have the potential to fluctuate in the upcoming days or months. The industrial chain will help you a lot. It provides a detailed picture of the trending industries, such as semiconductors and EVs. You can quickly find stocks either upstream or downstream, which helps you focus on target segments of an industry more quickly. Also, as segments are related to industries, you could predict price fluctuations faster without reading many research reports to determine the relationships within one industry. Link in description. An expectation that the market has for Tesla could be entirely wrong appears to be one of the three major reasons. It is no secret that the EV company missed consensus expectations by about 5%. To better understand this point, you have to be familiar with what Tesla refers to as the delivered to produced ratio. It is quite easy to understand. For example, refer to Q3 of 2021 and divide 240,000 delivered units by how many units were produced. That means there is a delivery of 240,000 vehicles, which is actually more than the 238,000 units made, and therefore has a delivered to produced ratio of 100.8%. Now, when the number is over 100, it means the company is delivering more vehicles than they have produced. In Q4 of 2021, that ratio was 101, which again signifies that they have delivered more vehicles than they have produced. It shows that manufacturing is behind how many vehicles you're selling. Now, in Q1 2022, there is a ratio of 101.5%. It can be noted that in the succeeding quarters given as an example, the numbers are going up, which means that the company is delivering more than they are producing. Simply put, production is significantly falling behind the deliveries. This has been the case for the last several quarters. That signals not just supply chain constraints, but also signals a lot of excess demand. Moving forward to Q2 of this year, Tesla produced 258,000 units, which were considerably low because of the Shanghai shutdowns. Still, the company produced more vehicles than they have delivered. That is the first deviation in the company's stream of numbers for the past several quarters. That said, the delivered to produced ratio in Q2 is 98.5%. Note that it is no longer over the 100 threshold, which signifies that the company is delivering more vehicles than they have produced. Now, it appears that the production numbers are starting to catch up to that of the deliveries. For Q3, although Tesla has yet to lay out a financial report, the company, through a press release, shared that they have produced 365,923 vehicles and delivered only 343,830 of them. That said, production represents a 53% growth weight rate from Q3 2022 to Q3 2021. However, it shows a substantial mismatch between the number of vehicles that were actually delivered and produced. In fact, Tesla only delivered 94% of what it produced. This has become a complete reversal from what has consistently been a problem at Tesla. Experts have always been noting that the problem at Tesla has always been that they were not able to produce enough vehicles to what we can deliver. Now that the situation appears to have been reversed, the market is now seemingly concerned that the excess demand for Tesla is over, and the delivery backlog is not simply just falling, but that it is gone. Some believe that Tesla is producing more and more cars with no customers buying them. Others are concerned that Tesla is no longer a product that can sell millions of units per year. Even the streets has concerns regarding this. Their fear is no longer based on the fact that the company can't keep production on par with the demand, but that Tesla will produce the vehicles, only that nobody's going to be around to buy them. That's the concern, especially in light of what is likely a global recession. And the ratio coming to 94% from the more than 100 delivered to produced ratios in the past several months is likely a potential red flag to markets. Still, Tesla argues that this is because of what they call a logistics nightmare. It is certainly not against the company's growth that they have produced more vehicles than they ever have before at a 53% growth rate. Most Tesla bulls understand that Tesla's move to delay deliveries to save cost is a brilliant move instead of delivering the vehicles for an added cost just to satisfy their target numbers. Tesla enthusiasts are well aware that there's plenty of demand for Teslas, and they believe that the company is doing the right thing by preserving its margins, especially at a time they're probably going to be greatly affected by currency exchange fees. In that sense, regarding problem number one, according to at least what can be seen on Twitter and in financial news, whether Bloomberg or Wall Street, Tesla still has an order backlog around the world of somewhere around 300,000 vehicles, so there definitely is no issue of lack of demand. This is moreover evidenced by the fact that there remain to be lead times for vehicles that rise above and beyond just supply chain constraints or battery constraints. The second problem points to the currency issue. Today, only 55% of Teslas are actually sold within the United States based on the Q2 report. Evidently, Tesla needs that number to go up because there will be no strong US dollar issue if more vehicles are sold in the United States. The strong dollar helps if more of the vehicles are sold in the United States. However, if more vehicles are sold in Europe or Great Britain with a weak pound or weak euro, Tesla will end up having to take an impairment for currency, a foreign exchange impairment. Finally, the third major problem appears to be Tesla's AI day itself. Many were not impressed with the prototype of the humanoid presented that day. It was not a success, to say the least. Of course, others have different opinions on that. Still, the robot received a lot of hate on Twitter, and that appears to have affected the stock, not to mention Musk's ties to Twitter itself. In fact, the EV company's stock's downward trend was believed to be, in part, sparked by the news that Tesla CEO Elon Musk has reversed course and now intends to follow through with his bid to purchase Twitter for his original offer price of $54.20 per share. Musk has been fighting in court to back out of the deal, but now intends to spend the full $44 billion he originally offered. That's likely the part that has Tesla shareholders on edge today, but it shouldn't be the only point of concern. It can be noted that Musk already sold about $20 billion in Tesla stock over a 6-month period beginning late last year. He sold an additional $7 billion in August as the fate of his fight to back out of the deal remained uncertain, and he might be forced to pay the full amount. Now he has agreed to that, and Wedbush analyst Dan Ives thinks he might sell another $2 billion or $3 billion of Tesla stock, according to Barron's. Still, that's not the sole concern for Tesla shareholders. In taking over Twitter, Musk has to now lead a company he damaged with repeated claims of fake accounts and incorrect reporting metrics. He will have to deal with repercussions that could include lost advertising and other income streams. Investors are rightfully concerned that that could take his focus away from Tesla at a time when the company is ramping up 2 new factories and fending off an influx of new competition. Experts have previously expressed that part of Tesla's success can be attributed to Elon Musk's leadership. Imagine saving on marketing and advertising funds by dissolving the PR department and instead funnel more funds into research and development. This explains investors' concern that once Musk acquired Twitter, his focus will no longer be solely on Tesla. Subscribe to Tesla stock for more updates.